Thank you. First of all, thanks for having us and having me on behalf of Savills and for gifting me gifting the moderation of this great panel with David and Christopher. I want to congratulate Fabian, the visionary who had the foresight that allows us to be here today, and who, with this merge with Clever Group, continues to be the soul of this event. And of course, congratulations to Clever Group for the acquisition of Forward, and the aim, as Julia said this morning, to take it to the next level that I'm sure you will. So the topic of this panel is investment radar, and when it comes to investment, is all about figures. But before we get into the topic, let me introduce you David Rico. He holds a degree in law and business legal consultancy from ICADE and MBA from the University of Houston. He has spent almost 30 years of his professional career mainly in banking, having worked at the Royal Bank of Scotland, Crédit Agricole, and Barclays Bank PLC. In 2010, he joined CaixaBank to lead the commercial real estate and hospitality financing activity. And since its launch in 2017, he has been director of CaixaBank Hotels and Tourism, a specialized business line with products and services mainly adapted to the hotel sector. He is also a member of the Tourism Commission of the Spanish Chamber of Commerce and a member of the Spanish Tourism Board. And regarding CaixaBank, is among the top 3 banks in Spain. They are the leading financial group in retail banking in Spain, consolidating their position after the merger with Bankia, and one of the most important in Portugal, where they control 100% of BPA with a socially responsible universal banking model that is committed to a close and quality service. Regarding the hospitality financing, CaixaBank Hotels and Tourism has granted 2,300 loans to hotels, campsites, and other tourist accommodation in 2022, reaching 2.8 billion in euros in loans and exceeding the 2021 figure, by 10%. So thank you for being with us.
Thank you.
And Christopher Martínez is Managing Director at Arcano Partners, leading the tourism, mobility, and education industries, both from traditional and tech perspective. Christopher has developed a large part of his professional career advising corporate transactions in the tourism, hospitality, and leisure sector. He previously worked as senior manager at Deloitte Corporate Finance. Formerly, he acted as vice president at Caixa Banco de Investimento, as supervisor at the valuation department of the financial advisory of AON, and as a senior at the transaction services department of EY. And regarding to Arcano Partners, he is the largest independent investment bank in Spain, being the indisputable leader in the domestic M&A advisory market with 80 deals closed since 2021, and with asset management division with over 9.5 billion of assets under management. So thank you, Christopher, for being here too with us. So now you know a bit better the main characters, and you will allow me to introduce a little bit of context for a better approach to this issue. We're talking about investment. So between 2009 and 2014, the investment in hospitality was not able to exceed the 1 billion mark, but since there, and with the exception of the 2020 year, didn't drop below the 2 billion, and there are projections of up to 4 billion. Regarding the 2023 end of year review, the hotel investment outlook for 2023 looks set to be a record year, however, with different nuances. derived from the very strong influx of the sovereign wealth funds as GSE, ADIA, or Lion, which have accumulated more than 50% of investment in large operations, such as equity portfolio, HIP, Mandarin, or Magaluf portfolio. The good news is that more accessible and long-term oriented capital has been introduced, particularly as it is a sovereign wealth fund. Its main objective is to generate the long-term returns rather than exclusively seeking for targeted returns. This strategic approach involves underpinning the fundamentals of the Spanish tourism market and is not limited solely to investments in trophy assets, which is really interesting, such as the Mandarin Oriental in Barcelona. Instead, the focus is on the leisure segment, both urban and resort. One example will be the Magaluf portfolio, located in Calvia and area. In the case of the equity portfolio, a significant portion, 58% of the portfolio, is allocated to urban locations with assets located in secondary areas of Spain, such as La Coruña and San Sebastián. This diversified approach reflects confidence in the fundamentals of the Spanish tourism market. That being said, the financial situation is playing a major role in making the structuring of operations for funds challenging. Regarding 2024, when projecting the hotel investment scenario, a more moderate period in terms of investment volume is foreseen. In principle, no major deals are on the horizon, and the current market is experiencing two different trends for the transactional market. On one hand, the good operational performance continues, with operating parameters even exceeding 2019 levels. The urban segment has been able to exceed 2018 RevPAR levels, even with lower occupancy rates. This, of course, keeps hotel asset owners in a comfortable position not to lower the prices. On the other hand, the financial complexity derived from the increase in the cost of capital is pushing those buyers conditioned by the financial situation to require discounts due to the high cost of financing. These two factors are generating a widening gap between the prices demanded by sellers and the offers presented by buyers. We anticipate a more modest year in terms of investment volume for 2024, with no major transactions now on the horizon. So with this context, the market show us, we will go deeper on the questions that I'm sure we will be able to give some, to clarify as much as we can the market. So first one, and I will start with you, David, if you don't mind. What's your view on the direction interest rates will take, and what is your view on the impact of this on the investment outlook for 2024 and beyond?
Okay, thank you. Good afternoon to everyone. Well, as I usually say, it hasn't not been the easiest time for any research department during the last couple of years, especially after COVID. Because to understand or to anticipate what is going to happen with interest rate, I think we need to have a look into what has happened during the last couple of years. No? There was an absolutely extraordinary situation post-COVID, where the economy was absolutely biased between demand and offer. There was a huge demand after COVID, but with a lack of offer for many reasons. And when that situation was starting to organize itself, then the war of Ukraine and Russia came and had also a huge impact in energy prices, mainly oil and gas. And that created another a new situation which changed the rules at the time. No? That was only 1 year ago. And there was an immediate impact in inflation, in CPI all over the world. which now is starting to be controlled due to the only tool that the central banks in the US and in Europe have in their hands, which is the interest rates. So to make the story short, I mean, after 2 or 3 years of big waves and movements, now with interest rates and with increasing interest rates, things are starting to get a little bit under control. Today here in Spain was announced the new figure for CPI, which keeps decreasing. So the current level of interest rate is showing that it is showing to be an efficient tool against the CPI. So what our bank, our research department anticipates is that the current interest rate situation, close to 4%, is probably going to be there for a few months, and it will only be at the end of 2024 when we may see a slight decrease in interest rates when CPI gets absolutely under control, which is, as probably most of you know, is the European target is to be at 2%. Okay? So with CPI 2% and interest rates at 3 or close to 2% as well, that should be the ideal situation. But in economy, it's very difficult to have a perfect or an ideal situation, okay? Because all of a sudden, there's as we are living these days, and there's a new war, there's a new geographic or geopolitical scenario. But as of today, we anticipate, as I say, interest rates to be reducing probably by the end of next year. And what is the impact? Your second question: what would be the impact into the investor market? Well, in theory, that is good news because the main problem during the last couple of years has been uncertainty. I mean, uncertainty about where did interest rates stop going up? Where was the limit? What was the limit as well for CPI? So that is really difficult for anyone to put into a business model. I mean, what is going to be the CPI inflation in the coming years? What is going to be the interest rate? That makes a bit difficult to put the price into things. Combined with, as you mentioned in your exposure, with a really good operational year. So you had sellers with really good figures and buyers with high interest rates and high inflation, which in theory should lower prices down. So there was a mismatch, probably during the last couple of years. And I think personally that when one of those situations, at least the inflation and interest rates can be adjusted, that should be an improvement because the uncertainty disappears. So that should be an improvement into business opportunities and transactions.
Interesting. Tough days to be analyst or researcher.
Yeah. Or buyer.
Or buyer, yeah, absolutely. So,
I very much agree with David's statement. I think that because of the, last year's turmoil, inflationary period of what's been in, we suffered interest rate increases. But we are now reaching a peak, and probably as the fundamentals, macroeconomic fundamentals of both Europe and the US are slowing down, probably during the second half of 2024, we are also foreseeing interest rate decreases at around no more than 500 basis points per year, until stabilizing the interest rate at 2.5, which is, in our opinion, the cruise level of the long-term ratio.
Okay.
Probably, sweeping aside the potential impact in transaction prices, which will occur for sure, what the potential bidders will see is better conditions when accessing to financing. So we'll accelerate somehow the number of deals.
Okay. So regarding this transaction angle or approach, so considering this buoyant scenario on the part of the operators and hotel chains, and the need for investment by capital, how do you think that this situation will affect the long-awaited price adjustment? Do you foresee it? We all wish.
It's been a long time since the last time I heard about gap reduction in price increases.
It's like the concentration in the hospitality sector, right?
Agree. Probably the hotel industry, the domestic hotel industry has traditionally been, I mean, pre-COVID, has traditionally been well structured, financed, and invested. And when the COVID came to our lives, I think the government helped a lot to the hotel industry, put a lot of efforts to support that specific industry, because for sure it represents roughly 13% of our domestic interior product, and the industry has been riding the crest of the wave since 2011, I guess. Probably the industry is well invested, and the hoteliers doesn't need to reduce the gap actually. So I'm not foreseeing a reduction, a gap, narrowing the gap in terms of price. I see because of the price increases on the buyer's end rather than on the seller's end.
Okay.
Well, I think the good news for this market is that well, Spain has a huge hotel supply and in terms of real estate, and it's well, quite, I would say, old these days, because we have been around for probably 60 years. So there's been an ongoing need for an update and for capex investment. So you can see in the figures that when a lot of this money, investor money, comes around, is for repositioning, value add, core plus investments. I mean, I think probably you know better than I that roughly 75% of the money which is invested from institutional money goes into core plus or value add repositioning. Okay, so that is going to be a need because of the age of our current hotel supply. So that is good news for the investors, and that is a need for the hotel operators. But having said that, Spanish hotel operators have been able during many years to update by their own means their hotels. So that is a bit the question mark. I mean, do we need so much institutional money, or can the hotel operators update their hotels with their own means? Well, I think there's not an easy or clear answer.
As soon as they are able to update their assets, so they won't need that. So, do you think that because you know, in the end, the driver to set up the price in a transaction of an asset is the business, and then we all know that the profit is increasing because of this increase of RevPAR without changing the products, so the EBITDA and the GOP are increasing. So in the end, if they don't do the translation of the business to the price, it is a price reduction in the end, because you're not raising up the price, but you're raising the profit you're getting from it. So do you see that prices, and a little bit of the guys, do you see the prices going up? Because now we're talking about reducing prices. They reduce the price or lower the price, but we can maybe talk about maintaining the price will be a reduction in the end, because if profit increases, it is a price reduction in the end, right?
Well, I think that, as I said before, I mean, you have, on the one hand, the operational, the EBITDA is going up, no question about that, despite the cost increases. So that, in theory, that should increase prices of hotel assets. On the other hand, you have the financial costs and other costs as well increasing, which should put some pressure into the value of the assets. So It's not the current situation is quite extraordinary in terms of if you have a look at the last years. I mean, things were more aligned, but because maybe both of them were of these elements were more stabilized. But these days is something which is not known for investors, and is putting a big question mark into the transactions, because, as I say, the sellers are really comfortable asking for a lot, while the buyers are offering less. So probably, in my view, there will be a differentiation between the operation business, which has the reason to ask for more money, against the real estate asset value, which doesn't have the reason to increase. So maybe we see transactions more on the separating real estate values and operational values. Okay, if you combine both, then we have the problem. But if you split those values, as I say, operational values are going up, while real estate should be well, not going up, or at least stabilized. Yeah.
I agree. Somehow a stagnation in the price increases of the real estate is something that we are seeing, but the operators are beating records on year, and we see, this kind of transactions will remain as they are now, with huge prices and very difficult to execute, as we are seeing, because there is a clear lack of asset-light related deals in our industry. I mean, in Spain. And maybe this is the reason why.
Okay, and regarding those, it's not the best time to invest with leverage, but what are the most active investment profiles that you see nowadays working and trying to close deals? Christopher.
The leitmotif for investors. I mean, sweeping aside the asset-heavy industry, let's pay attention to asset-light. We are seeing new players putting a step in our industry. Traditionally, it happened around Spain, but especially in Madrid, there was a clear lack of large international operators that now they are, having a look at this city, and Madrid is playing a role in Europe in terms of tourism. So I see a lot of interest from this kind of players, large international players having a look at the city, trying to gain scale and to gain footprint with operations.
Okay. And I will do the same question for you regarding investors, but I will link it with the answer Christopher gave to us. So how do you see, when you analyze, when you were in CaixaBank, how do you see the newcomers of this market regarding to the operational? Do you rank it the same way, or you need to do a great research abroad, which is something sometimes it's difficult to compare two different markets? I mean, I see companies coming from Greece or other countries. And then if you can answer both.
Well, for us, probably in the last, I would say, 5 years, the most difficult thing to analyze probably has been two sectors which have arrived in these last 5 years, and which were quite new for Spain. No? And they were both the ultra luxury or the really expensive hotels, which in Spain there was not a presence of these ultra luxury hotels, and now they are a reality, and that required us to understand other markets, Milan, Paris, London, so this to understand this product. And on the other hand, the hostel industry, again, was not something which was happening here in Spain. So those were probably the two sectors that required more analysis from our side, because In Spain, the main supply is in the 3 and 4 stars in beach hotels or resort hotels. That was the easy product for us. So that didn't require such analysis. There was clearly an upgrade of those 3 stars into 4 stars, but that was something, I would say, normal or business as usual. But probably the 2 other ones I mentioned, hostels and ultra luxury, have been a bit more challenging from our side to finance those assets. Yeah.
Okay, and linked to this, we have 2 more questions. Need to go fast. So regarding this, it looks like there is a polarization on demand, where winners are budget and luxury. So regarding and linked to this forum, so do you see? I mean, they're coming. So we are hearing now Four Seasons going and analyzing Granada. We're seeing the Mandarin Oriental going to Sevilla. So how do you see that? Is a trend? Is a hype? Is there a reality that can be standardized in the next future? How do you see Spain towards this luxury segment and not just Madrid or Barcelona?
I think apart from Ibiza, Mallorca, and Barcelona, there was a clear lack of luxury tourism around Spain. Main reason why is because we didn't have a luxury hotel offering, and things are changing. Madrid is an obvious example for this matter. Now we are seeing large luxury tourism in our city, and the main reason why is because we do have a clear luxury offer in terms of hotels. Having said this, luxury tourism, I think, is somehow acyclical, or not so much correlated with the economic cycle, so somehow resilient to economic cycles. This is the main reason why hotel operators, large hotel operators worldwide, are having a look at Spain as a key place to put a flag in.
Okay.
Well, yeah, much agree with Christopher. I think what we have learned from luxury is that, and also from post-COVID, is that things have changed. I mean, obviously the economic Spanish situation helps a lot for tourism, not only 3, 4, but also luxury, because the fact that there's savings, the fact that there's job, and the fact that payrolls are increasing, and there's employment, obviously that helps a lot tourism. And from our research department, we also have analyzed that tourism and leisure have gone up in the scale of priorities. I mean, that is something which was anticipated a few years ago, now is a clear reality. I mean, we can see that by our customers and their expense, and clearly that is increasing. So now it doesn't mean that all of us can afford ultra luxury, but it's a bit aspirational, and many people, instead of spending 2 weeks, they spend 3 days in one of these hotels. Mm-hmm. So clearly the economic situation is helping that segment. Yeah.
Okay, good. John, I would say that Ibiza is more a expenditure destination, and Madrid is a luxury destination, because different. Sometimes the driver is how much the tourist spend, but it doesn't really or necessarily means that it is luxury in the end. In Ibiza there are 2 different areas.
Universes of tourism.
Yes. And then the last one, and really fast, because we cannot close this table without talking about sustainability, ESG. So your vision about the ESG, we recently received these new rules regarding to how it is ranked and how we to proceed within this area. So your vision about the ESG, and we close the panel.
Okay, from our side, I mean, it has been said that this could even be a trend. For us, clearly, I think it's not a trend for the banking system. I think we are putting a lot of effort into supporting the transition or the green transition of our hotel buildings, and so definitely and usually we are 50% partners with many of the investors. I mean, assuming a 50% leverage in many of the investments, obviously the bank has a lot to say in that, and that is a must for us. But not because we just want to be sustainable, but also because as any other company, a bank receives financing from investors, and those investors are forcing us and asking us as well to put our money into green transactions or ESG transactions. Okay, so that is going to be.
It is a chain.
Definitely.
Okay. I agree. It's a clear worldwide trend. We've been gaining awareness in terms of ESG during the last years, and it plays a key role when analyzing a transaction. Especially from the institutional investors' perspective, where it's a mandatory tick in the box. And in fact, we are seeing new institutional investors raising pockets for impact investments, where ESG plays a key role, for sure.
Okay, thank you very much, David and Christopher. Hope that it has been useful and fruitful for you. And thank you for your attending here.